We had some reasonable data coming out of the United States yesterday. Durable goods numbers in line with expectations. We had initial jobless claims a little bit better than expectations, but the market choosing not to focus on those and rather perhaps focusing on some of the reform we're about to see in the financial sector.
Absolutely, Stephen. Just generally overshadowed, and I think the focus has really been mainly on the home data, US home data that we saw earlier on in the week. But yes, the financial reform is coming to conclusion very soon, and I think just a little bit of panic as to what the final picture will look like there. So we see a lot more focus on that now, and a lot more reaction to it. And it hasn't been a good reaction. The Dow closed, and the S&P closed, just a little bit over 1.5% yesterday. So yes, generally a very bad start, obviously in our markets this morning, where we're now trading down about 0.5% at the moment. But that's in line with what the global implications have been for the US financial reform.
Of course, that housing data earlier this week, we had existing home sales on Tuesday not looking very good. We had new home sales, that's new builds, on Wednesday looking even worse, in fact, worst on record. And of course, the housing sector is where the whole crisis started. And apparently, hundreds of thousands, in fact millions of houses or homeowners in the United States are sitting on negative equity at this stage. So not looking very good for the US consumer at this point.
No, certainly not, Stephen. And I think on top of that is that employment hasn't really been created at the pace that we would like to see. I mean, the US recovery, I think the big question now is at what pace will it happen? I mean, we've got the G20 meeting this week, and I think the general topics there will be the pace of the recovery in the US, as well as the financial sector overhaul. But I think that just goes to show that the consumer is still struggling. Retail sales data have also shown us that the consumers are not going into the malls and spending their money, and are not buying houses, where, as you said earlier, that's where everything started and is the pillar of recovery at the moment. So definitely not very good news out of the United States, and that's where the market is focused at the moment.
Well, given those G20 meetings this weekend, how much focus do you think will be on the US GDP data that's out this afternoon, as well as the University of Michigan Consumer Confidence Index?
I think what we're hoping for there is just for it to be in line with the expectations. The market is expecting about 3% GDP quarter on quarter for the first quarter. But I think we're just looking for something that's in line with expectations. And then obviously focus is going to be on what solutions, if any, that the G20 and G8 summits will be able to come up with, because there hasn't been anything that's really concrete and been a little bit of a long-term solution. So that's what the market is looking for. But yes, should GDP numbers become out worse than expected, we'll see an adverse reaction in the market into the close, and perhaps into next week also.
And of course, you have 20 countries going into those meetings, all with their own agendas, so it might be difficult to get consensus at the meetings. And of course, we've had US President Barack Obama cautioning Europe on its austerity measures. It's really still focused on trying to spend its way out of recovery, so they have to find some sort of common ground.
Yes, they do need to find some common ground, but also, the European issue also comes in there. As we saw earlier, the Greek CDSs, which is the credit default swaps, have widened to record levels. So the debt issues in the Eurozone still remain a major topic of concern. And, and what solutions will come of there, and what equitable solutions and long-term solutions these summits will bring forward is what the market is looking to see and looking to analyze. So yes, definitely. I mean, it needs to be equitable, and it needs to be a little bit more longer term.
Of course, in the meantime, we've had the new Australian Prime Minister coming into office, Julia Gillard, and yesterday morning we saw a positive reaction to that announcement, with Julia Gillard saying that she was going to be reviewing that mining tax. Yesterday morning we had Billiton shares up. They closed weaker in the South African market, and they're down about 1.5% this morning at one stage. So it looks like, having digested that news, the market's not quite as positive that there are going to be big changes to that mining tax.
Yes, I think, initially it seemed as if she was more sympathetic to the miners, and, she even, cut the Australian government campaign for the mining tax, and maybe put a stop to that a little bit. But the initial reaction was that, this is somebody that maybe can end up scrapping the tax on the mining sector, in Australia. However, it seems as if it may take a lot longer than anticipated initially, and that, you know, perhaps it may not be equitable to the miners. It may not be something that they're looking for, that they may still have a hefty tax that will actually impact quite adversely on their bottom line. So I think what the pullback is seeing is people actually digesting that information and thinking, you know, maybe it's not going to be as a rosier picture as they initially thought it was going to be.
We've also seen some weakness coming through in the rand, trading around 768 at the moment. And of course, we had those current account numbers coming out yesterday. We had the first quarter bulletin. We also had PPI data. Do you think the rand's responding to that, or do you think it's just following the general market sentiment at this stage?
Yeah, I think reaction to the worse than expected current account deficit was yesterday. You know, really today what we're seeing is a reaction to, you know, the Eurozone, Greek versus German bond spreads there going to high levels. So that's what we're really seeing, and a risk aversion certainly coming back into the market. So we've seen quite a pullback in the euro, where it's, you know, trading at about $1 or 1.22, somewhere near there, and where the rand has gone up ever so slightly from yesterday, but still trading a little bit weaker there at about 6.75, somewhere near there. And so we're just seeing that that reaction is really mostly to risk aversion rather to yesterday's figures. Of course, that still contributes to it, but really today it's about risk aversion coming out of the Eurozone, and also anticipation as to what is going to happen in the G20 meetings, and also just you know, uncertainty regarding the decisions that will be made there.